Hi, I'm James Nelson, Principal and Head of Tri-State Investment Sales, and I'm here to bring you the Nelson Report for August 2019. And a special treat for today, I will be giving up the interviewer role and switching. Gail Donovan, our Senior Director from Avison Young, will be asking questions of me about our first half sales report that just came out. Gail is a former reporter, so she promises this isn't just going to be softball questions. She's going to really dig in there and help the audience here try to make sense of the market and our recent report. So, Gail, welcome. Thank you so much for doing this and everything that you do for Avison Young. And congratulations, you just received BizNow's award for a New York Power Woman. So,
thank you, James.
Congrats.
Thank you.
Perfect. All right, so let's dive in.
Well, thanks so much for having me today. I appreciate it. I've read the second quarter property sales report from Avison Young. And what kind of activity did you see in the investment sales market in the first half of the year in terms of transaction volume and dollar volume and pricing?
Right. So this was definitely a tough year, and I think we all felt it at the end of last year. And I always like to remind people that when we report these statistics, we're really talking about rearview mirror, right? Because these transactions that showed up in the second quarter were likely negotiated almost 6 months ago. So by the time that contract was signed, typically anywhere from 30 to 90, 120 days to close, and then to get reported, come through the transfers, and then be consolidated in a quarterly report. What these numbers are really telling us is what was going on around the beginning of this year and even late last year. So the sales figures were off quite a bit. In fact, the first half of this year for all New York City sales, and we look at $5 million and up transactions, only totaled about $14.1 billion. That's about a third off of last year, 2018. And really looking at this historically, and I know oftentimes we point back to that 2015 record year of $77 billion, which I think was one moment in time. But really, when we look at the 10-year average, that's what we're really looking for, is that normalized activity, which was about $43.3 billion in sales. So if you look at annualizing what happened so far, we're on track to do about $28 billion in sales, which is unfortunately quite a bit off last year's figures. And the 10-year average, yeah.
And so do you see any bright spots? What about the office market? What about retail? What about development?
So it is the broker's job description that the glass has to be half full. And I really had to think on this one because, again, the numbers across the board are not good in the sense that in addition to the dollar volume coming down, the market this year is on pace for all of New York City less than 1,000 sales. Now, again, the 10-year average is about 1,600, so it's not like we do thousands and thousands of sales here, but still pretty lean. And most impacted, and I know you want to talk about the multifamily market, so we'll get to that in a minute. But let's talk about some of the opportunities in the market. The office market has performed really, really well. Even though the dollar volume was down, price per square foot on average was actually up 23% in the second quarter in Manhattan when you compare it to the trailing 4 years. So that was an increase of 23% to about $954. And I probably should have warned those of you who are listening to this right now to have their pen and paper here. And don't worry, we can get you the market reports because you're going to hear a lot of stats today, but really I think helps tell the story. So yeah, office sales very strong. Retail even dipping a bit to $2,000 a foot on average. That's about a 14% decline. But retail has been, as we know, been hit really hard over the last couple of years. I think it's time for a comeback there. And then land sales, I think here you're going to see a really big uptick. And although there was only 9 land sales that happened in Manhattan over 200,000 feet of total buildable, which is really not a lot, the average price per square foot actually came up to $767 a foot. So you are still seeing some demand for condos. So that's really, we are seeing appetite renewed interest in some of these asset classes, which will not be a surprise after we kind of talk about what's happening in multifamily next.
So that brings us to the multifamily market. In June, the state passed the Housing Stability and Tenant Protection Act of 2019. Can you tell us a little bit about that particular law and what's involved and how the real estate community is reacting to it?
Sure. So, as you know, we did have 2 prior podcasts where we had some of the best landlord-tenant attorneys really dig into the implications. So for you listeners out there, if you have not heard those episodes, it is really worth digging in, because it is there is a whole host of new changes, and I was reminded by one of our listeners not to call it reform. Reform means we've improved it, we've made it better, and unfortunately this is not a good thing for affordable housing. I know we've talked a lot in the past. We agree that the city needs new affordable housing. This unfortunately does not accomplish it. What it does is really freeze those million regulated housing units in time. There's really no means testing where someone has to qualify for it. So again, that was really the subject of our prior show. So let's talk more about the implications and what that does to the market. So as I mentioned, the market was already sensing that there was dark clouds on the horizon here. And as a result, in the second quarter, the volume was down by 23%. I think if we look, and we'll come out shortly with our mid-year for multifamily citywide, I think you're going to see that decline even more pronounced. Pricing already sliding down 17% on average per foot. Cap rates coming up on average to about 4.2%. Again, for a fully regulated building where you have those rents essentially locked, you no longer have the ability to decontrol, you're really going to be at the city's mercy as far as where those increases are every year, and then looking to manage expenses. So, you know, the days of 3 to 4 caps, does that end up becoming a 5.5, 6 cap? I think I said on the last show, I mean, it's still New York City, right? And so at a 5.5, 6% return compared to some of these other markets, I was speaking to a fund that said they were able to, they bought into a 4.25 cap in North Carolina, right? So, you know, here there's still an opportunity. I believe that the debt is very plentiful, and this is a great time to lock in long-term debt, but the consequences for fully regulated buildings could be very severe as far as volume, first and foremost, because I don't think a lot of these long-term owners all of a sudden start selling off their holdings. I think a lot of them are saying, look, I'm going to just wait, right? And so where we are seeing a lot of attention is for the fair market product and for the 421A regulatory agreement buildings that are exempt. So we'll see if help is on the way. So today, and we're recording this a little early for August. We're getting ahead of the game, but RSA and CHIP did file their lawsuit today, challenging New York's new rent laws in federal court. So we'll all be watching that closely.
Now, one of the things that has been particularly troubling is the young elected officials, in particular, have maligned the real estate industry and landlords in recent months. Can you tell me what kind of positive contributions do you see that the real estate industry has made in New York City in the last 30 years?
Sure. So the real estate industry has a long history of supporting the city, and certainly with housing. If you look at going back to the 70s, from what I've heard, really tough times here, city on its knees, and the real estate community came full force to create this housing that was so much in demand. And it's really been, I think, a wonderful partnership with the city over the last few decades to really rebuild. I mean, clearly, you look at the World Trade Center after 9/11, the industry coming back and being such a driver, and the city has become such a more livable place today. You look at the activation of the waterfront. I mean, when I got into the business 20 years, no one was talking about, you know, Brooklyn, Queens, let alone the Bronx, and there's such interest today in the borough. So we had so much positive momentum, and unfortunately that we're really at an inflection point right now. The private sector is here to help, but it's got to make sense for them. And going back to some of these recent changes, if you're not going to incentivize investors to improve apartments, they're not here to do the city's job. The city, if the mandate is to provide affordable housing, yes, the private sector can help you do that, but they're not going to, you can't force that entire obligation onto them. And I really believe that is the basis for this lawsuit that's going to go straight to the federal courts, and we'll see if it ultimately goes to the Supreme Court. But I think that is a big part of the case that they are looking to make. And then the last thing I will say is the real estate industry is about half the city's budget, right? So the city's budget has ballooned from $80 billion to now $90 billion, and it's really been the real estate industry, because of the rising real estate taxes, which get passed on in many cases to the tenants, the transfer taxes. And these changes, when you see a drop in volume like this, drop in transfer taxes, you start controlling rents where real estate taxes are based on those RPIEs, the income and expenses. We'll see if the assessments start going down based on this. But I've heard estimates that capping rents and regulation, the city could forfeit about $2 billion in any given year in just the additional tax revenue that could have been generated by letting buildings rents go to market. And then you could use that money for programs to create additional affordable housing. But unfortunately, that will not be happening now.
Now, if you had your wish, what kind of programs would you see to create affordable housing in New York City?
Right. So I think they were already, it's a fallacy to say that we were losing affordable housing. In fact, we've been creating it. In fact, I think the stat I heard was 8,000 units last year, and a lot of it was through Affordable New York. And there, you gave developers an incentive, a tax abatement for 35 years to go build housing, and part of the trade-off to get that abatement was to provide anywhere from 20 to 30% affordable housing. That affordable housing that was provided is means-based. So unlike the current stabilized stock where anyone can get a stabilized apartment, the housing under the affordable housing in the Affordable New York plan, you have to qualify for it, and then you go into a lottery. But certainly there's still a huge need, and I don't think that New York City can accommodate it all. I think we're going to have to be looking throughout the metro area, and that's why you see, for example, RXR adding 5 million square feet in New Rochelle.
Now, one of the things that I've seen, especially in the boroughs, is a lot of protest on any kind of new development. Mm-hmm. And is that constraining our ability to provide affordable housing?
No question. So, as you know, we're big fans of Seth Pinsky, and I've interviewed him and had this discussion before. Also interviewed the commissioner, Marissa Lago, and I think both of them agree you cannot be pro-affordable and anti-development. So there is this, NIMBYism where not in my backyard, but the city's transportation system, our infrastructure, there are areas that can accommodate density. And if you look at the housing stock that has been added, over the last decade, the overwhelming majority of it has come from building towers that are over 25 stories. I mean, if you're just dropping a bunch of 5- and 6-story buildings, you're not going to get there.
Now, under Bloomberg rezoned probably a third of the city, mm-hmm. and a lot of it was upzoning on commercial corridors and downzoning in, say, historic districts. Mm-hmm. And I've noticed that has been a tremendous asset, and because we have been able to build up in a lot of the Brooklyn corridors, for example.
Mm-hmm. Yeah, and certainly along the waterfront, and it's really watching these areas become energized, and it's not just more residential density, but it's really thinking about it's really good, solid urban planning where having retail, thinking about which of these areas can really accommodate this density. But it is a big driver, and if you don't allow the city to grow, I mean, look at San Francisco, for example. San Francisco is out of location. They actually have a cap on how much you can build, almost to the extent that I've heard some of the office spaces are now leasing before they're even entitled. So tenants are signing up for entire buildings before they've even been approved. So no doubt they're turning away tenants where they're saying, look, we'd love to open up in San Francisco, but there's no room. So they're going to go somewhere else. So we need to continue to think about how we can accommodate this growth and continue to attract tenants.
Well, I think one of the things that people don't realize is this latest, let's say, development boom is very recent. I remember in 1998 walking into the downtown Marriott, and it was the first hotel that had been built in Brooklyn in 50 years. And that's just 20 years ago. And Must Development took the risk, took the chance, and built that hotel. And so obviously since then we've had a lot of new hotels, we've had a lot of retail, we've had a lot of new development in Brooklyn. But it takes a risk. These developers are taking a risk by being the first one.
Right, no question. And when I started my career 20 years ago and focused in on Chelsea, and I saw that 6th Avenue corridor, which was all flea markets because it was a low manufacturing zoning, and here it was right on top of the F train, and then suddenly said, okay, we're going to give you 10 times residential zoning, and overnight, 30-story towers popped up, which was great for the neighborhood, but I think the opponents would say, where's the affordable housing? So I think this new Affordable New York program is really working because they're saying, okay, we're going to give you the ability, we're going to give you tax abatements, but there does need to be this trade-off for affordable housing, and it works. Whereas some of the other areas where now this current administration is saying is if you want to get an upzone, you have to have mandatory inclusionary housing. And to build affordable housing, it's really it's a break-even proposition at best, and so you're seeing a lot of the developers say it's really not worth it to build, and that's when it's saying, okay, it has to still be economically feasible. Developer takes a lot of risks to do this. So it's certainly something that we need to continue to focus on and accommodate growth here in the city. So
where do you see the opportunities today in New York City?
So we've been big believers in the boroughs, and if you watch the expansion in the Bronx and certainly Brooklyn and Queens and now even Staten Island, and a lot of that does have to do with the transportation. So that's where maybe Staten Island is still a little bit challenged, but I mean, if you look at what's happening in the Bronx and to be able to, hop on an express train and be in the city, in 30, 45 minutes, is very attractive. And I think the Opportunity Zone programs that have been enacted is going to drive a lot of investment in these areas. So I think if you're an Opportunity Zone investor, you're doing this because you're looking for that stepped-up basis in 10 years. So if you're to bet, where am I going to get the most appreciation in 10 years? Is it going to be in some, secondary or tertiary city? Or the fact that, on average, if Manhattan is trading for around $1,000 a foot and Brooklyn's $600 and Queens is $500 and the Bronx is $200, that's a pretty big disconnect in pricing. So I think that gap needs to close. But I still think there's, in certain neighborhoods, there's certainly room to run for office. And you see that a lot of these markets now, especially downtown, Midtown South has just been on fire. And we know that. We've seen the triple-digit rents, but we just did a really nice panel that you helped organize on the Garment Center. Which is now Vornado's calling the Penn District, and they're getting triple-digit rents too. But look at where it's located. Look at the city. Look at where the transportation is, and you're seeing that tenants want to be in areas that are 24/7, that have the services. So it's really, I think that's kind of the next chapter, because you see, I mean, Hudson Yards has already been a screaming success. Over 10 million square feet of tenants who have headed over there. And so definitely still good reason to be excited about office, but also with just being cautious about the type of concessions that are having to be given to secure these tenants in the form of free rent and TI. So I think there's certainly room to be optimistic about office. Retail I already spoke about, but just to kind of talk a little bit more about that, I mean, some of these retail corridors, I mean, look at Broadway and Soho. So in the peak of the market, I mean, I watched in a 5-year period, those rents go from $350 to $400 to $500 to $750 to $1,000 a foot. We're probably back to that $300-$400 a foot range. Maybe for some spectacular space, maybe you can do a little better. But in the meantime, the cap rates have also expanded. Average cap rate in Manhattan for retail now in the high 5% range. I mean, if you can lock in 10-year debt, around 4% plus or minus interest only, I mean, you're getting some really good cash on cash return. So I think those are certainly two ideas to look for. And then development, we know how severe the housing need is, but we've seen a lot of developers hit the pause button because of the question about prevailing wage. So what has been one of the bills proposed that was not included in this last session was that if there's any development in New York that does receive subsidy, that it would have to be built with prevailing wage. And there's a lot of big-name developers who have said, if that happens, we're out. We are not, because it does not make sense to build rental housing in some of these neighborhoods, especially affordable, if you have to build with that prevailing wage. And I think the cities, especially construction, it's really evolved where you see open shop really working, where union labor, non-union labor coming together to accommodate this need and do it in a sensible way. So I think that's something that we got to watch, because if not, we're going to see that development number, this development project languish. The byproduct of that, of course, is if you hold off on development, and we've just freezed 1 million regulated housing units. I mean, the existing housing stock in theory, based on those challenges, is actually going to become more valuable. Not that that's what we want to see, but it is supply and demand at the end of the day.
But in addition to that, one of your previous guests, Jonathan Miller, had talked about the increase in demand for rental properties, for apartments, because of the new tax laws. So people aren't buying; instead, they're renting. And so he said that demand is greater. So now we have more demand than ever, and less product.
Yeah, I think I've got a lot of friends who are on the sidelines right now, and many of them have been on the sidelines, by the way, for the last 10, 20 years, just waiting for the correction to dive in, and it never, seems to happen for residential. But yeah, I mean, there's a lot of factors today. I mean, if you look at, the transfer tax has increased, and yeah, it was only 0.4%, but it adds up. And then the mansion tax, I mean, which used to be just 1% over $1 million that the buyer would have to pay when buying residential. Now there's a scale, and if you go all the way up to 25 million plus, you're almost at 4% that you tack on to the cost. So there are some considerations there, and there is concern about that. Certainly the ultra luxury segment of the market, where I've heard anywhere from 8 to 10 years supply. Now, at the end of the day, how many units are we really talking about? So 2-3 years ago, there was 3,000 apartments on the market in Manhattan. So maybe now that number becomes 6,000-7,000, maybe 10,000. But in a city of 3 million plus housing units, it really is a drop in the bucket. I think the thing is that because of the land prices, and in Manhattan, we said they're still at over $750 a buildable on average. Although you got to be careful when we're only averaging these over 9 sales. I wouldn't, because I know I'm going to have a lot of clients call me after this and say, James, why can't you sell my land for $750 a buildable? But that clearly, when you pay those kind of land prices, which what was happening over the last couple of years, when you do that, you're not, building workforce housing. I mean, you're building ultra luxury condo projects that are $2,500, $3,000 a foot, and there's just too much of that on the market right now.
So let's talk about the bright spot in New York City. We have really very strong economic indicators. Can you go into some of the positives about New York City right now?
Sure. So job growth is the number one driver for the real estate market because people show up, there's jobs created, they need apartments to live, they need more office space. So despite everything that's happening with the political climate, some of the most successful companies are looking to grow because they know that we have the workforce. We have great universities here. We have a lot of venture capital that's setting up shop here. I know you had done some research on that. Do you remember what the venture capital numbers were? I found this interesting. There was a big increase.
That this is the New York City Controller report. He puts out a quarterly report. Total venture capital investment in New York in the metro area rose 64.9% from a year ago to $4.46 billion, and this was in the first quarter, year over year. So that's the highest quarter level on record.
Right, and is that even higher than Silicon Valley? Do we know?
We're not as high as Silicon Valley. They're still number one.
Okay,
but we're catching
up. We'll get there. And do you have the job numbers also? I think because May, New York City reported. I think we've been averaging about 90 to 100,000 jobs a year. What was the latest stat?
We have in the last year over year in May, we gained 95,000 new jobs. Yeah. And so we've been gaining about 100,000 jobs year over year. And so it's been, we had something like a 17% increase in job growth between 2012 and 2019. Right. So we're over 4 million.
And it's a very diverse, New York City historically was really dependent on Wall Street, right, and the finance industry, and now you're seeing clearly the TAMI companies, but also education, healthcare. We'll see if we can get some more life sciences here. But you look at tech alone, and Google's commitment to this city, having just purchased. Or actually just signing a lease, St. John's Terminal, so $1 billion investment in Hudson Square, but also purchasing 450 West 15th Street for $591 million from Jamestown, the former Milk Studio building. So this was after, originally they bought 111 8th Avenue for $1.8 billion. Then they bought Chelsea Market, I think $2.2 billion. Now they're buying this. They've expanded out onto the Super Pier and now Hudson Square. And Google, which has 8,000 employees here in New York, are saying that they want to try to add 1,000 a year. So when you think about every single one of those jobs that Google adds, how many of their jobs are created as a result? And, Facebook, Uber, a lot of reports out there, LinkedIn, of being out there, and Amazon, after all that, in Queens, looking to bolster their presence here in Manhattan. So clearly they're doing that for the workforce. That is a number one reason to be bullish about New York, because that is going to drive the demand that isn't just going to filter through to office, but clearly residential. They're going to go out, they're going to be shopping. So that's going to benefit retail and ultimately, hopefully, get our development sales back on track. Perfect. Well, I think we are almost out of time here. So, Gail, this has been a really fantastic conversation. So, appreciate it. And I know typically I'm doing the interviewing, but I think with these stats that we just saw, it was really important to let our audience know And please do contact us, and whether you're looking at our website at aytristateinvestmentsales.com, or please link in to us. Please follow us on Instagram and Twitter. We put out a lot of research and a lot of content. We really, and I learned this by the former founders of Massey Knackle, going back to those days, that we're really in the information business. And so we want to be really on the forefront of the trends, helping our clients, our friends, investors make the best decisions for the future. So again, we just appreciate everyone who's been tuning in and spreading the word about the Nelson Report. And we wish you all a fantastic rest of the summer, and we'll look forward to picking it back up with you all in September. Thanks again, Gail.
Thank you.